If you're an incorporated business owner in Canada, you face a fundamental question, maybe one you grapple with all the time. How should you pay yourself? Should you take a salary or should you pay out dividends? There's this really persistent myth out there that one of those is way, way more tax efficient than the other. So today, we're going to put that idea under the microscope and see if it holds up.
But before we dive in, just a quick note. This analysis we're about to go through is purely for educational purposes. Our goal here is to bring some real academic clarity to what is, for many entrepreneurs and professionals, a pretty complex subject. Okay, let's just get right to the heart of it. You've probably heard this before, right? Maybe from a colleague or you read it on some online forum. The idea that taking dividends from your corporation is the secret handshake to a lower tax bill. But is it really true? Is it that simple? To get to the bottom of this, here's our roadmap. First, we're going to walk through that common misconception and see why it's so appealing. Then, we'll uncover the critical piece of the puzzle that almost always gets left out, the corporate tax. After that, we'll put it all together to build an integrated tax picture, look at factors that go beyond just the tax numbers, and finally, talk about how you can make the right choice for your own situation. So let's start where this myth is born. It begins with a very simple, surface-level calculation, one that honestly seems to make the answer pretty obvious.
Let's imagine a scenario. You're a business owner, and you want to pull $100,000 out of your company to live on. You've got two main ways to do it. Take it as a salary or pay yourself a dividend. All right, so if you go the salary route, let's say you're in Ontario for this example, you take that $100,000 as income. When you file your personal tax return, you're going to see a tax bill of roughly $20,000. Pretty straightforward. This is the calculation most of us are familiar with. Now, let's look at the other side of the coin. You take that same $100,000, but this time as what's called a non-eligible dividend, which is very common for small businesses. Well, you'll find that the personal tax you owe is significantly lower, coming in at around $13,000. And right there, that's it. That's the birth of the myth. When you just stack these two personal tax numbers side by side, you see what looks like a $7,000 savings. And you think, wow, case closed. Dividends are clearly the way to go. But here's where, as academics, we have to pause and ask the critical question. Does this simple two-step comparison really give us the whole story? Or is there a massive piece of this equation just missing? The flaw in this very common analysis is really a sin of omission. It completely, and I mean completely, ignores the taxes that have to be paid inside the corporation before a single penny can ever be paid out as a dividend. And here is the absolute key difference you have to understand. Dividends are a distribution of after-tax profits. Before your company can give you a dividend, it has to earn that money as profit and then pay corporate income tax on it. A salary, on the other hand, is completely different. It's a business expense. It's deductible. It actually reduces the corporation's profit, often down to zero. So let's scrap that flawed approach and do this the right way. Let's build a complete integrated tax picture that looks at both levels of tax, corporate and personal, together. Okay, look at how the story completely changes when we start at the corporate level. On the left, in our salary scenario, that whole $100,000 is a salary expense. That expense wipes out the profit, so the corporation's taxable income is zero. No corporate tax is paid. But now look at the right, the dividend scenario. That $100,000 isn't an expense, it's profit. So the company first has to pay corporate tax on it, in this case, about $12,200. That means there's only $87,800 left over to even pay out to the owner. And now for the main event. Let's combine both levels to find out the total tax paid from start to finish. For the salary, it's simple. Zero corporate tax plus about $20,000 in personal tax for a total of $20,000. But for the dividend, we take the smaller personal tax, about $10,000 on that smaller dividend amount, and we must add back the $12,200 in corporate tax that was already paid. And all of a sudden, the total tax paid in the dividend scenario is actually higher at around $22,200. And if you're a visual person, this bar chart makes the new reality crystal clear. That $7,000 in savings we saw earlier, it's completely vanished. In fact, in this particular example, the total tax bill is a bit higher with dividends. The point is, the two options are much, much closer than that initial myth would ever lead you to believe.
Now, this isn't some accident or a coincidence. It's actually by design. It's a core concept in our tax system called the principle of integration. The system is intentionally structured so that, in theory, the total tax you pay on income should be roughly the same whether you earn it directly as an individual or through a corporation. What we just walked through is that principle in action. So, now that we've kind of debunked the pure tax savings myth, let's broaden our perspective. Because this decision isn't just about minimizing a tax rate, it's about building your entire financial future. There are other critical factors to consider. First, a salary requires you to make Canada Pension Plan contributions, which builds up your future government pension. A salary also generates RRSP contribution room, a key pillar for retirement. Dividends do neither of those things. Secondly, some personal deductions like childcare expenses can only be claimed against employment income, like a salary. Third, and this is a really practical one, lenders usually find it much easier to verify salary when you're applying for a mortgage. On the other hand, in some specific situations, paying dividends can actually trigger a tax refund for the corporation, so it's not always a one-way street. So, with all this information, how do you make the right choice? Well, you have to reframe the question. It's not just about simple tax minimization. It's a much bigger strategic decision about your personal finances. You can really think of it like this. Taking a salary is, generally speaking, a strategy that focuses on long-term security. You are actively building your government pension, you're building your capacity for private retirement savings through RRSPs. The dividend strategy, on the other hand, often puts the focus more on immediate cash flow because you avoid those mandatory CPA deductions, and frankly, the payroll administration is a lot simpler. Ultimately, this is the key takeaway I want you to have. The optimal choice isn't about chasing the lowest possible number on one specific tax bill. It's about aligning how you pay yourself with your real, long-term personal and financial goals. And of course, I must say this. While this explainer gives you the framework for thinking about the problem, every single person's situation is unique. Tax laws are incredibly complex, they vary by province, and they change. It is absolutely essential that you consult with a qualified professional accountant to figure out the best strategy for your specific circumstances. So, we'll leave you with the final question, which is really now for you to answer. Knowing that the big tax savings are largely a myth, what are you truly trying to optimize for? Is it about maximizing the cash in your pocket today? Or is it about building a foundation of financial security for tomorrow? The right answer lies in your goals.